Did you know that according to popular estimates, as much as 90% of people lose their money in the stock market, and that is counting both new and seasoned investors? Well, in today's video, I'm going to talk through some of the main reasons as to why this actually happens and actually give you some steps on how you can avoid these simple mistakes that people make so that you can enjoy a long, healthy, and most importantly, wealthy relationship with the stock market. But of course, before I do, if this is the first time that we have met, my name is Christos Fellas. I am an investor from the UK that makes all kinds of videos on managing, making, and investing money. So if that is something that may interest you, then consider subscribing. Okay, so how do 90% of investors lose their money in the stock market? And there is actually only really one way how this can actually happen, and that is simply buying shares at a high price and selling them at a low price. Now, I know what you're thinking. That's obvious, right? But actually, it's the most common mistake that people still make within the stock market today, and in fact, it's technically, like I said, the only way that you can actually lose money. But why do people still buy stocks at a high price and still sell them at a low price? Let's now jump into some of those main reasons as to why that happens, and I guess let's start off with the most common of them all, and that is patience. So many people still look to the stock market today as maybe a quick double up opportunity or some kind of get rich quick solution, and it is simply not the case. It never has been, and it never will be. In fact, the best way that I suggest anybody looking at the stock market from a time and patience point of view is by using a thing called the rule of 72. And basically, to use the rule of 72, you simply just take the number 72, of course, and divide it by the investment that you're making's expected annual return. From there, you will get a number, and basically all this number is realistically the number of years that it should take for your initial investment to double in value. For example, if I was to invest £10,000 into the index fund VUSA, which actually has an average return of 15.13% a year based on the past 5 years' results, using the rule of 72, I have worked out that it should take me roughly just under 5 years to double my initial investment and be left with roughly £20,000. Where most people go wrong with investing is when they place an investment into either a fund or a company, they see little gain in such a short space of time, and then what they do is try and sell that stock or that fund and try and move on to something maybe a little bit more exciting. You simply just can't go about and keep buying and selling the same shares just because they are not performing the way that you want them to. This simply will just never ever work. A brilliant quote actually that I absolutely love from Warren Buffett is that you can't produce a baby in 1 month by getting 9 women pregnant, and that pretty much refers to everything that I just spoke about. Alright, so the second reason why so many people lose their money in the stock market is by investing on the basis of rumors, stock tips, and hype. Now, I'm sure at least once in your life you've had either a friend or family member come up to you and say, oh, I think this company's price is going to blow up in the future, and they've almost gone and sold you the dream of getting rich on that one stock. Sometimes they could be completely wrong, sometimes they could be spot on, and it could be the best investment that you have ever made. But the mistake that so many people do is that they just jump straight into an investment without doing any of their own research. One great example of this is the recent buzz around cryptocurrencies. I cannot keep up with the amount of articles that are talking about the next big coin to go to the moon, or what price Bitcoin is going to be next week. And whilst it is all fun and games and I absolutely love it, and some people have done really well out of it, most people have lost a good chunk of their portfolio, especially due to the recent crash that has happened in the last couple of weeks. Just a quick disclaimer before I get any crypto hate in the comment section down below. I absolutely love the blockchain technology, and I am a big believer in Bitcoin and Ethereum myself, but the point I'm trying to make is that most people are invested based on what someone else has told them, not what they actually believe in. And all of this actually just leads me to my next big reason as to why people lose money in the stock market, and that is people simply just don't do enough research into the companies that they are investing in. A really good way I like to look at this is when you go to buy a new TV, or let's say a video camera, for example, you spend absolutely hours researching reviews, checking out the features of the product, looking at the price on the internet from different retailers. So why should that be any different when you're buying an actual business? Another really good thing to note is actually being able to understand a business actually helps you become more patient, like I just mentioned with your investments over a long period of time, and most of the time it will stop you making those rash decisions and potentially panic selling a stock at a loss. The example I'm about to use, I use in so many of my videos, but I'm going to use it once again because it's just so damn good. But let's just take a look at this Apple chart. As you can see, in the short term, you can see the stock going all over the place with different ups, different downs. Every single day it is moving in a different direction, but over time, the successful business model that Apple has always prevailed. And if you zoom out, you can really see the major gains that this stock has seen over a long period of time. The next reason why so many people lose money in the stock market is by putting all of their eggs into one basket and not being diversified enough. If you can get this one thing right, you will be setting yourself up for massive success in the stock market, in my personal opinion, and you will greatly lower your risks. But still today, some people still get this so wrong, and this can be a costly mistake to both new and experienced investors. One rule I like to follow is to have no more than 5% of my portfolio invested into an individual stock at one single time. And I am constantly checking and rebalancing my portfolio to make sure this doesn't happen. One mistake I personally made early on was buying way too heavy into the tech sector, which of course are normally great performing stocks, but it just simply wasn't diversified enough, and it could have potentially landed me in hot water given something bad happened within that sector at some point. The top tip I have for especially beginner investors is to look into investing into either index funds, mutual funds, or ETFs. These are great ways to diversify your portfolio and give you massive coverage across all industries and sectors just by making one investment. Alright, so the next reason why people lose money in the stock market is by investing money that they just simply can't afford to invest. When it comes to investing, you should only be investing spare money that you can completely afford to lose, and money that if it wasn't there, it wouldn't make any difference to your day-to-day life. Now, of course, this isn't something we want to happen where you just lose your money and not care about it. Of course, you want to be able to care about it, but it's the mindset that I'm talking about that you should have. Let's say you actually go and do the opposite and maybe take some money out of your emergency fund, or maybe you even go to the lengths of remortgaging your home. Trust me, I have seen people do this, especially in this recent crypto boom. It hasn't really ended well for them, but basically what you are then doing is using money that could be needed desperately for another time. And then what would happen is, let's say something came up where you desperately needed that money, you would then be forced to sell your position in a stock during a time where you shouldn't really be selling. So just to summarize on this one, set money aside for your bills, build an emergency fund of about 3 to 6 months worth of your outgoings, and anything left over, invest into the stock market. Now, what I have done is left this mistake, and the one that I believe to be the most common mistake, until the end. And this one pains me so much to still hear today, despite this myth being proved wrong over and over again. And that is, people spend way too much time trying to time the market. There are so many people out there still today claiming they know when the next stock market crash is coming, and that is absolutely ridiculous. The real truth is there isn't a single person in the world that can predict what is going to happen with the stock market, and over the past few years there has been countless amounts of times that has proved that point to be true more than ever. No one could have ever predicted the events that took place in 2020 and still live with us today. I'm sure you know what I'm referring to. And just a more recent one, no one, including a particular hedge fund actually that lost over $7 billion by shorting GameStop, could have actually predicted the insane rise that it had in early January. Now, if these guys that are getting paid hundreds of thousands of pounds to try and predict the stock market can't get it right, then the everyday investor is definitely not going to get it right either. The number one saying that sums all of this up, and I actually posted this the other day on my Instagram, and that is, time in the market always beats timing the market. And I guess there is actually no better proof in the world than just showing you this chart here. As you can see, this is a chart to show the different values you would have if you invested $10,000 in the S&P 500 from the year 2000 to the year 2019. And basically, as you can see, if you just simply invested $10,000 in 2000, left it 19 years and came back later, you would have a total value of $32,421. However, if you just missed 10 of the best trading days of that entire 19-year period, you would potentially be left with half of that amount. Now, don't worry, I won't go through all of them, but one that is completely eye-opening to me is that if you missed just 30 days of those best trading days during that 19-year period, which is 3,935 days to be precise, you will have lost almost half of the initial value of the amount that you started with in the first place. And to me, there isn't any chart in the world to explain why 90% of people lose money in the stock market better than the one that I have just shown you. So there you go, guys. They are the main reasons as to why people lose their money investing into stocks and shares, and probably why it has received the undeserved reputation it has over the past 20 years. One thing I do have to say though is that if you were to manage to stick to your basic principles and avoid these mistakes, I am definitely more than confident that you will find yourself in that other 10% who don't lose money, and hopefully you can start to build long-term growth within the stock market and beyond. Just one thing for me, if you are still watching this video, and before you go, if you did find any kind of value from this video, then it would really mean a lot if you liked it down below, maybe left me a comment as well, and subscribe to the channel if you haven't already. Apart from that, you guys take care, and I will catch you in the next one.